What kind of loans can you as an investor get? We're going to talk about that today and a whole bunch of different types that's going to help you with your next acquisition. The first one that you as an investor are probably going to want to consider is a DSCR loan, or which stands for debt service coverage ratio. It basically is a loan that says, hey, you tell us what the property is, what you're going to make or are making in rent, what the expenses are, and we'll give you a loan just based on the factor alone. You don't have to have extra income sitting in a bank and all the qualifications and all that fun stuff that banks are going to require. It's just the property. Does it make sense? Yeah, we're going to lend on it. Now, it will cost you a higher interest rate as a result, but they're much easier to get and can be a very flexible option for a lot of investors. The second one is a commercial bank loan. This is kind of a traditional financing route that a lot of people do. Usually local banks like working with local investors, and this is a good way to get your project financed. Usually pretty competitive interest rates, but the downside is that there are shorter amortization periods and they're going to want it repaid in generally 5 years or less. The third one is a portfolio loan from a bank. So if you have a whole group of assets, oftentimes they will set up a kind of line of credit, so to speak, that you can draw from. And then the whole portfolio of real estate that you have is the underlying asset to support that line of credit. That can definitely be flexible once you have it set up. It'll be some work to set up, but can be a good way to add some financing along the way. The fourth one is agency loans. So agency loans oftentimes stand for Fannie Mae or Freddie Mac loans, which are backed by the faith of the U.S. government and function similarly to a traditional residential loan, which is also backed by the same agencies, in that they're usually 30-year amortizations. They have really good interest rates and are fixed for a really long period of time. However, they're a lot more work to get, and you have to jump through a lot more hoops. You have to meet certain qualifications. So generally, these are used when you're starting to get to like the $4 million and above price point for a particular product. The fifth one would be private money loans, which are just like, hey, investors that you might know, they decide to lend you a loan. Now, key to understand here is that private money loans cannot go out to like an owner occupant or, someone who's occupying it as their residence because of the Dodd-Frank Act and the requirements around being a qualified lender. However, it does not apply to investor loans. So if you're an investor, you can get a loan from another investor, and that can help fund your deal and your acquisition. The sixth one is a hard money loan, which is just an institution making you kind of a flat loan instead of a private individual. And these can be, again, usually pretty flexible, but they're going to come with a really high interest rate. 7 would be a bridge loan, which is kind of akin to a hard money loan in that it comes from an institution set up to make loans on investments, but generally they're a little more sophisticated. They're for a significant period of time. They're going to require a lot more underwriting with the property, but then of course come with a better interest rate as a result of that. And the 8th one, don't forget seller financing. That's my personal favorite. And you can have, basically you make all the rules when you get seller financing. So don't leave that one out. If you can get that, make sure that you're covering it, and it's really going to benefit you as an investor at the end. So I hope these brought you some value. If so, please like and share. And if you're looking for investments in Pennsylvania or Maryland, reach out to us. We're happy to help.